the more of the bank's money you can put in at a lower interest rate, the higher your returns go.
Hey guys, what is up? And welcome to episode 7 of How to Invest in Commercial Real Estate. My name is Braden, and I am joined by my co-hosts Joel Thompson and Brian Duck with Precision Equity and the Criterion Fund.
Hey,
thanks for joining us again. And today we are diving deep into a few terms that I think could change a lot of people's lives, and a lot of manipulation can go on in them. The 3 terms are net operating income, capitalization rate, and cash on cash. And if you can get a good grasp on these 3 terms, I think you can start underwriting most deals. You can start learning the fundamentals of where these properties are making money, how you can leverage them with debt, and how you end up paying your investors at the end of the day.
Well, importantly, we've got to go really slow as we're talking through these, because I have a few really smart college-educated friends, and I'll throw these terms out and try to tell them, cash on cash returns and leveraged returns and NOI, and the concepts are not hard, but you have to really know the basics and what's behind them. So let's go into that today.
Sounds good.
I think one of the biggest ones is capitalization rate, or the cap rate, and that's a big one because that's the base underlying factor in understanding the profitability of that property that you're trying to buy, the cap rate.
Agree, but I think in order to tell them about cap rate, we're going to have to use net operating income.
Okay.
And so I think we should start with what is the net operating income of a real estate deal. So I'll start by saying that you have a property that generates what we'll call revenue. Revenue is just all the money that comes in from owning that asset through rents, reimbursable expenses, and things like that. So
you could even have a laundry or something.
Laundry, yeah. So late fees, all of the fees, all of the money that brings in, that's top line revenue. And then from revenue, you start to subtract all of the expenses. And we won't detail all of those today, but main expenses are what? Utilities,
insurance,
taxes,
maintenance,
management fees. All of that comes off. And so whatever you're left with after all expenses have been paid, that is your net operating income.
Right, or kind of rough profitability. If you were to run that business, that net operating income, or NOI, is what you're going to make before any debt has been paid. That's gross profitability, right?
Yeah, fair enough. So NOI, so Braden, how do we go? You talked about capitalization rate. So let's talk about what that means in relation to net operating income.
Yeah, so the capitalization rate is really just your unlevered return. And I know unlevered. So assuming
pick easier words.
Assuming you bought that property in cash, if you were to buy it on an 8% capitalization rate, or an 8 cap rate, that property would make you 8% return, 8% return on your money. So if it had a $400,000 net operating income, a gross profitability of $400,000, and you were to buy that on an 8% capitalization rate, that property is going to be $5 million. So you buy a $5 million property in cash, it makes $400,000 in NOI. You're making 8% in cash.
Yep. So we have this example of $5 million, and I happen to be lucky enough to have, not me, but whoever's buying this has $5 million in cash that they want to buy it for. So you don't have any debt on the property. After all expenses, what's left in your bank account each year is $400,000 if that's an 8 cap deal.
Right.
So $400,000 in cash flow, in net operating income. Let's see if there's a way we can say that. I hope that came across well. Is a all cash deal. If you get 8% on your money that you have invested, that's the cap rate.
Okay, and which is better? I mean, it seems obvious, but when you're buying this property, which is better, a high cap rate or a low cap rate?
It depends. You're going to get more return from a higher cap rate deal because it's making more money.
Right.
So a 10% cap rate deal is making you 10% if you bought it in cash, versus an 8% cap rate deal is making you 8%. Mm-hmm. Right. So your nicer deals, the more stable deals, are going to trade at a lower cap rate because they're more stable. That's kind of how you can judge.
Well, by stable, you mean the risk profile is different.
Right.
So the higher the risk or perceived risk, not even maybe actual risk, the higher the yield people will need, or the return people will need in order to invest their money in it.
Right.
And so the more secure, the more stable, and the more consistent the cash flow that you can get from the investment, then the more people are going to be willing to pay for that, and that brings that cap rate down.
Okay, so are you saying that when you buy a property, similar properties tend to trade at the same cap rate? Is that right? I mean, so if you're buying multifamily and it's Class B and it's located in this, most of the properties in that area of the country or whatever are going to trade at a similar cap rate. Is that right?
Yeah, they'll be similar, and the astute investor will know the differences, between the slight differences between cap rate and which one is more valuable. But yeah, generally they're going to be the same for asset class.
So a cap rate is a good way for a novice investor of commercial real estate to go in to a certain area and know about what he or she should pay for that property. Is that accurate?
Yeah, absolutely. You need to start at the end when you're evaluating a deal, and you need to decide the bare minimum you want to make on your money. Mm-hmm. So you can use a cap rate to do that, because and we'll get into this a little later, but you know that you can leverage an 8% cap rate deal with some additional debt and make more money on.
Yeah, but the thing is, if I'm buying and I know in the future I'm going to sell, I need to be at a certain cap rate, because if I way overpay for this property, when it comes time to sell, then someone who's knowledgeable that's going to be buying from me is not going to buy at a wildly different cap rate than
Right.
the market.
Right. There's market cap rates for sure. In different regions, in different markets, you have the primary, secondary, tertiary markets, and then you have the different asset classes that we discussed in a previous episode. And each one of those asset class and each one of those markets is going to have a market cap rate based on the age and location and everything like that. Okay. Absolutely.
All right.
But a lot of different factors in the properties will change the cap rates.
Sure.
So, okay. So now that we've got the cap rate, which is the percent return on our money if we paid all cash, the great thing about real estate is that we get to leverage it or borrow money from the bank to help us buy it, so we don't have to use all of our cash. Mm-hmm. So Brian, you're the stock guy. How often do you get to borrow money to buy stocks?
Well, actually, most people can open a margin account. And a margin account with stocks, I don't think anybody is going to let you borrow more than 50%, but those are highly risky, because now all of a sudden, if you go buy a stock and it moves against you, then you're losing twice as much as of what you put in, basically, right? So if you go buy a stock for $100 and you put in $50, and on your margin account there's another $50, and it starts dropping, then it's dropping twice as much as what you really put in. So, or twice as fast. So margin accounts typically aren't recommended. Now, if the stock goes up, then obviously you're making quite a bit, but you're also going to pay interest on that margin just like you would a loan. So you're paying that. You're paying some commission fees, and so most people don't recommend that you open up a margin account in stocks. So that's highly risky.
Yeah, so I think we've talked about the power of debt in commercial real estate and the advantages of using it. So how are we taking this 8% cap rate deal? It's a $5 million deal. It makes $400,000 in net operating income. So it's an 8 cap deal that we're buying. How do we take that $400,000 return over our $5 million and make it better with debt? How do we do that?
Yeah, banks surprisingly will loan up to 80-85% in some cases against that asset. So let's take our $5 million property example, and let's say that the bank agrees to lend us 80% of that amount with their money, and that's a $4 million loan. Well, so what happens is I have my $400,000 in net operating income, but now I've got a mortgage payment to pay.
Right.
And so we have that number here. If I went out and I got a $4 million mortgage at 4% interest, which is kind of a going rate today, and we got it on a 25-year amortization. And so for those that don't know, that's how long we're going to pay it back.
Right.
So your house is typically on a 30-year am, but commercial real estate outside of Fannie, Freddie, and the multifamily world is generally 25 years. So that's what we did. And the payment, the yearly payment for that $4 million we borrowed from the bank at 4% is $253,361.
Gotcha. So you're taking the $400,000 you had in net operating income, and then below that, you're going to say, we're going to go get a loan, a partner to help us with the purchase price on this. And in exchange for their $4 million on the $5 million purchase price, we have to pay them $253,000 out of the $400,000.
Yep.
So then after we pay that, we're left with about $146,000.
$146,000 roughly. And that number we call in real estate is cash flow.
Right.
So that's the cash that you have after all of your expenses and your debt.
Right. So you take your net operating income or your gross profitability, you subtract any debt, principal and interest, and that's your net cash flow. And that's really what you can distribute to your investors or yourself at the end of the year. That's the net cash you have at the end of the year. That's what you made. And the beauty about this is, I don't know if the viewers or the watchers have done the math yet, but a $400,000 return on a $5 million property, you bought that in cash, that's 8%.
Right.
$146,000, which is our new net cash flow because we got that 80% loan. And our down payment was only $1 million because the bank covered the other $4 million. Now we're making 14.5% return.
Right. You almost, on this particular example, you almost double the return just because of the leverage you can get from the bank.
Right.
So in other words, the reason the reason that you're using leverage is because you're getting the same net operating income, but you're putting less money into the deal. And then you have to pay your debt, but overall that's increasing your return. Is that essentially what's going on?
Absolutely. It's just, it's a spread game. So this property we decided makes 8% without any debt. It's an 8% capitalization rate, and we're borrowing money at 4%.
Right.
So the property makes 8, we're borrowing the majority of the money at 4. That delta we get to keep and add on to the 8 with our original. So our million was still going to make that 8%.
Right.
And then we add the delta between what the property makes and the interest rate, and then we get to add that onto our return as well.
Okay.
That's
so the cash flow number that how do we get to cash on cash? Because that's one of the 3 numbers that we wanted to tell people today. We wanted to talk about net operating income, which we've done. We want to talk about cap rate, and then now we want to talk about cash on cash, because that's really one of the most important metrics for us as syndicators is what is that cash on cash number?
Yeah. So when I think of cash on cash, I think of cash, and then I think of a line like a division line, and then I think of cash below it. So the cash on top is the cash you made in the year. That's your net cash flow. And cash on bottom is the cash it took you to get that cash flow. That's how much you invested in the deal. That's your capital balance. We wrote $1 million check, so that's on the bottom, and we have $146,000 in net cash flow. That's on top, and then you just do the math problem. You made 14.5% cash on cash.
I was trying to explain this to my kids the other day, and they're 10, 12, and 13, and they were having a hard time with the concept. So I came up with this idea. I said, hey, think about commercial property as a money generating machine. You know, like a golden goose that lays the egg. This money machine, I tell them, is if I put $100 in, it spits me back 8. Mm-hmm. So I made my return. The return money is 8% of the 100 I gave it. And so then in our example, what if you could go borrow money and feed it to the money generating machine, and it keeps spitting you back 8, but you're only paying 4% a year to borrow that money. Mm-hmm. And so that's how we get the leverage, is the more of the bank's money you can put in at a lower interest rate, the higher your returns go. Yeah. And so we have 14.5% cash on cash just for getting a loan from the bank. What if, I'm going to show you how important leverage is what if we go with an 85% loan? Someone would say that's just a little bit different, 85%.
So you're just getting a touch more debt, and you're putting a touch less down payment in.
Yeah, and so if you're listening, think about, well, how much could a 5% loan alter my returns? Because we already had our show about returns and how drastic even a few points of compounded return over time benefits you. So in this example, if I go and I say, okay, I'm going to get an 85% loan, that means I'm getting a $4.25 million mortgage. Same interest rate, same amortization. The payment goes up slightly. It's $269,200. So my cash flow goes down to 130,000. And so you're like, well, why would you want to do that? Your cash flow went down. Well, I only had to put in 750,000 in this example. And so then my cash on cash is 17.5%. So I just went up 3% on my return just for increasing my leverage a little bit.
Right.
But one other thing I want to point out is this is a mortgage. So you're paying, part of the payment that you're paying is paying the interest, and part of it is paying the actual principal amount. And so
it's paying that money back.
It's paying that money down. So the longer you own that commercial asset, right, the balance of that mortgage is coming down. And as long as the value holds and you sell, you're going to get all that money.
Yeah. Just like your house, right?
Just like your house.
Yeah, but on a much larger scale. Right. So, I mean, just the principal pay down could be, 5 to 7% a year.
Well, let's look at it. I calculated that for us. So in our first example of 80% leverage, we had a 14.5% cash on cash return at an 8 cap deal, 4% interest on the debt. Well, if you add back the principal to that return, the theoretical return, it bumps your cash on cash is 14.5, but your total return is 24.5.
Wow.
Or almost 24.5. So you're earning a 10% return on your invested capital just from the principal payments.
So when you are going to a bank for a loan on commercial real estate, are they going to give you different terms or a different interest rate for different maybe LTV loan amount? And so if so, do you need to, I guess you just go analyze the 2 or 3 terms that a bank might give you. Is that right?
Yeah, I'll tell you, man, a bank will change the interest rate by the day. I mean, bank changes interest rates with everything, by the way the wind blows. So, you need to be in the market, shopping debt, talking to your lenders who are underwriting the deal and ask them what the rates are. And you need to be talking to other people. I would say, generally speaking, when we go into a deal, we're putting in a rough number in probably, 20 to 30% higher, just so we have a little buffer. And then we hope we can negotiate that rate down. But I mean, just a quarter of a percentage point or a half a percentage point on the debt savings could save you hundreds of thousands of dollars over the course of that loan. Mm-hmm. Because if you're getting a $4 million loan and you get a 1% cheaper interest rate, that's $40,000 a year. That could be a 10-year loan. That could be $400,000 in extra interest on the debt. So paying attention to that rate and negotiating it and having good lenders are very important.
Well, and as the LTV adjusts, you may get, let's say I want to reduce the bank's risk and only borrow 70%, the interest rate may be lower for that than the 80% because there's less risk from the bank's perspective.
Right.
And another thing I'll say on leverage is obviously we can get really good returns getting 80% LTV deal, but obviously it's not as safe as buying in cash because swings in the net operating income now affect your returns drastically because you have that debt payment. Mm-hmm. And so that's something to keep in mind when you're buying deals is that the more debt you add, the more perceived risk it adds to the deal. Although my experience in the last 10 years is we've been able to find really good, stable deals and put 75 to 85% debt on them, and there was still enough cash flow to contend with the swings throughout the year.
Right. Yeah, well, I think these 3 terms are super important. I think if you can understand how the property is making money, the net operating income, and then how to take that net operating income or the profitability of the property and apply it to a purchase price because you want to buy it. So, hey, it makes this much in NOI, and I want to make this much on my money. I know if I can get around an 8% cap in cash, then I can go find a good lender, get some good debt, and then that 8% deal turned into almost double. And if you include the principal pay down, it could be almost triple.
Well, so I want to go, we got a little bit more time. I just want to give another example about how powerful that cap rate is when you're buying and selling. So let's say, and also increases in NOI. So we have the NOI, the net operating income. Part of real estate and manufacturing value there is being able to increase that NOI. So let's say on this example that we were able over a few years to increase the net operating income by just 10%.
And real quick, you're doing that through rental increases. You're doing it through occupancy. People are paying you more money in that year. That's how you're getting that increase.
Yeah, it could be that we're raising rents. It could be that we're maybe fixing up units and being able to charge more for the same unit. And it could be that we leased vacant space. If the apartment complex had vacancy or the retail center had vacancy, we'll lease that up. So that's how you might get an increase in NOI. I'm taking a pretty modest increase of 10%. If you said, hey, the rents are going to go up 2% a year, you can get to 10% in less than 5 years. Mm-hmm. And so what does that do to our return? If we assume that we sell at the same cap rate that we bought at, on this example, then a 10% increase in NOI would be $40,000. And so the value that adds at an 8 cap is $500,000 in value to the property. Wow. Now, remember, in that 80% example, we only put in $1 million. So not only are we getting double-digit cash-on-cash returns, and if you add the principal, we're up to 24% combined return. But now, if I can increase that NOI when I sell, I get another 50% on my money just for 10% increase in NOI during the ownership period.
Yeah, that's less than inflation.
So crazy when you get into cap rates. Crazy how much return is in both an ability to increase the NOI, the net operating income of the property, and one other thing is for us, we're always trying to find opportunities to buy deals at a slightly higher cap rate and be able to sell them at a lower cap rate.
Yeah, and that was to your point earlier on market cap rates and finding a deal. If you can go into a market and know that, hey, in this market, a good retail asset is trading for an 8% cap rate, and this one's a 9.5% cap rate, there's a value to be had there.
Yeah. So I just looked at what if I could buy at an 8 cap and I could sell the same income. I didn't even increase the NOI. Just I remarketed, or he was a little bit more desperate to sell, and I'm going to use a better broker to get a national platform, and I'm going to sell at a 7.5 cap versus an 8.5 cap, an 8 cap. So I'm only getting a 0.5 point on the cap rate. That doesn't sound like that much, but on our example, just a 0.5 point in cap rate increases the purchase price over $330,000
on the same
income. Didn't increase the income at all. I just basically remarketed it at a slightly lower cap, over $330,000 in purchase price. So that's over a 33% return on our invested money without even moving the NOI. And the point, I think we're talking about these things we wanted to define them to make them easy to understand, but also to show just small swings in cap rate and in NOI and in leverage point can drastically drive strong returns for you or investors.
Yeah, absolutely. Finding cap rates, being able to understand them in a market and make money there is a lot. Being able to place good debt on a property and no good debt, and have those relationships, you can make a lot of money there. And then being able to bump up the income on an asset and sell it for the exact same cap rate. It's the exact same cap rate. You're just getting a little, 1-2% every year. You hold it for 5 years. The NOI went up, 10% over that time. And just that money is hundreds of thousands of dollars. That's a lot.
Well, in that example, it was 10% equaled 50% return on your invested equity on that first example with an 80% loan. So
it's amazing how just little tweaks here and there can make so much more money, but that's because you're talking about a $5, $10, $20 million property, right? So just little bitty increases can really help.
Yeah, and the probability of you getting more than one of these on the same deal, like the probability of you getting good debt, you being able to increase the income of that property and then fix it up and extend the leases and make it a more attractive investment so you can offer it at a lower capitalization rate. You can convince somebody else to make less on their money than you did on yours when you bought it, is essentially what it is, because you took care of it. You proved the asset and you proved that you could make it make more money. That's a believable story, and somebody else can come along and buy that, and then bang, that's a lot of money, man.
Well, and this is an assumptions game. So if you're listening, what makes a good syndicator or makes a good commercial real estate investor is making a bunch of assumptions about what future cash flows are going to be, what the risks are. But in any event, even if we don't make any aggressive assumptions on commercial real estate, it's still a good investment. let's say there's no NOI increase. That's not going to happen, but let's say there's none. And let's say I'm going to sell at the same cap rate. I'm not going to be able to improve on that at all. If it's a financeable deal, you can still get consistent 15% cash on cash returns. I mean, an 8 cap deal and a 4% loan, like we've talked about, those deals are available to people. So I just think it's a good thing to remember that we don't have to make wild assumptions to make really good returns. And then obviously we have some where we do hit it out of the park, and cap rates do move in our favor, and the NOI does move up, and then the returns are really big.
You know, I want to have a really important point of clarity here that we're not saying that you have to go and do this by yourself, right? Because our investors are investing with us on the deals we're buying, the three of us. You know, you're buying tons of deals with Precision. We're buying deals with Criterion, and our investors are investing alongside of us to get all of these benefits with us, and they're getting those same returns. They're getting 12, 13, 14, 15, way more % return when it's sold, right? Mm-hmm. So you don't have to go just find a $5 million property and say, hey guys, I want to buy this. You know, I've been watching this podcast. These three guys make it interesting. You know, do a deal with somebody else. Sign up on our email list. Get involved with a deal. Figure out how it works. Get comfortable with it. Study on these terms and understand how you can manipulate net operating income and capitalization rate to your advantage, because there's a lot of money to be had there. And if you can root this with some knowledge and motivation and ambition, it doesn't have to be your full-time job. You don't have to be full-time in commercial real estate. You don't have to be a lender, a real estate broker. You don't have to be anything. You have to have a little bit of money and the willingness to learn and partner with somebody else.
Yeah, if you have apprehensions about what we're saying, the terms, it seems scary, let knowledge be your guide. The knowledge will combat that fear over time. And the more knowledge you get, the more comfortable you'll get with commercial real estate as a potential avenue for you.
Absolutely.
Yep. Braden, what you said, that's how I started, just as a passive investor, still had a full-time job, but just by investing and paying attention and the syndicators sending me information, financial information, and studying that's how I learned.
Yeah. Well, all right, guys, I think that wraps it up for today. Make sure to go to our website. I think that's the easiest place to watch and listen. It's howtoinvestinCRE.com. Like, subscribe, check us out, and we'll be back in a few days.